When the Federal Reserve speaks, the market listens. And these days, the Fed is speaking a lot.
Busy week for Fed speak.
Fed speak.
Fed speak.
So much Fed speak as well.
Throughout 2024, investors have eagerly been following Fed press conferences for signals around interest rate cuts. And it's not just Fed Chair Jerome Powell they're listening to. New research shows that other members of the Fed also move markets in significant ways through public comments. But what happens when Fed officials disagree? As anticipation for clarity around rate cuts intensifies, so has the debate around how the Fed communicates with the public.
Far too often people play what it's become actually an absurd parlor game of parsing every word out of every Fed official's mouth.
What we found is with 19 Fed officials speaking, they've become a play-by-play commentator. And we saw last week what that does to market. It imposes an unnecessary amount of volatility onto it.
And these policy shifts have big implications for American businesses and households.
When the Federal Reserve makes a series of U-turns, not just one, but a series of them, which is what's happened over the last several years, that undermines public confidence.
So does the Fed have a messaging problem? And how can it remain transparent without creating uncertainty? The central bank wasn't always so chatty. When it was founded in 1913, the Fed had limited communication with the public, and its policies were largely a mystery. Things really started to change in 2011 under then-Fed Chair Ben Bernanke, a few years after the financial crisis. And currently, under Chair Jerome Powell, there are now 8 press conferences per year, one after each FOMC meeting.
Fed officials begin talking more. They begin talking to the press more. They begin giving more speeches. And the Fed starts to believe that the more they talk about things, really the better off markets are and the more effective and credible their monetary policy is.
There's a good case for transparency. The idea is that when the Fed makes policy changes, more communication with the public helps give the market a heads up as to what's coming, and therefore it can make policy more effective. It's like giving a weather forecast to the economy, so people can plan their financial decisions for rain or sunshine and clear skies. And research shows that in practice, this increasing communication from all members of the Fed, not just Powell, has an effect on markets. A new joint study from Oxford and Duke University analyzed more than 1,500 speeches given by Fed members between FOMC meetings. Depending on the language used in the remarks, researchers assigned the speech a hawkish or a dovish score. They found deviations in the score could predict increases or decreases in risk premium, amounting to 17% of intermeeting volatility of the 10-year yield and 15% of volatility in intermeeting stock market returns. But experts say there can be a flip side to this transparency. Markets have learned to trade based off of any and all signals from the Fed. So when there are more signals, sometimes with rapidly changing messages, things can get confusing.
It's harder for market participants to figure out what's going on sometimes when more people are talking. That's for sure. They don't know exactly who to listen to. They have to listen more often. And so it becomes a harder thing to do.
For example, in November of 2023, most Fed officials were indicating steady interest rates, citing ongoing inflation. But in an off-the-cuff remark, Fed Governor Christopher Waller suggested rate cuts might actually be possible in the upcoming months. Markets latched onto the comment. The 2-year yield, which usually moves in step with interest rate expectations, fell 9 basis points in reaction. Later that week, Powell pushed back on Waller's comment to contain expectations. The S&P seemingly ignored this and continued to rally. Things took a turn when hot inflation reports began to come in.
Actually, it wasn't quite a pivot. It was a Michael Jackson moonwalk. He walked back all expectations.
So you have December, they make a pivot towards rate cuts. By the time March rolls around, they're pivoting sort of away from those rate cuts. It's a double pivot. I think that would be called walking in the NBA. You'd get a foul to turn over the ball.
Research shows that markets are particularly reactive to Powell. A study from the Center for Economic Policy and Research found that volatility during Powell's press conferences was 3 times higher than during those of his predecessors Janet Yellen and Ben Bernanke. The researchers say this is because Powell's messaging tends to depart from the initial FOMC statement released after the meeting.
I think there's an argument, though, that The Fed may or may not talk too much, but I do believe sometimes they react too much. And I think there's a difference between talking and reacting. So you can talk and you can repeat your prior commentary and your prior forecast or prior view. It's when you change your view frequently that might be speaking too much. I think sometimes the officials and maybe the Federal Reserve as a whole doesn't stick to a framework and say, here's what I think is going to happen. Just because a number comes out that doesn't jibe with your forecast doesn't mean you should change your forecast or change your outlook.
So what's the answer? Andrew Levin was a former special communications advisor to Ben Bernanke. He says the Fed can minimize these U-turns and increase credibility by using something called scenario analysis in its public communications.
In the wake of the pandemic, the world's been a very uncertain place. Things haven't gone according to plan, especially with the economy. So the Fed repeatedly has been in a situation where its analytical tools weren't very effective in helping lay out a baseline plan. Those baselines have had to be changed dramatically over and over and over again. Well, that's exactly a situation where you want to shift to scenario analysis. So you're not just emphasizing a single baseline anymore, you're emphasizing a range of possible outcomes, like a good weather forecast.
Ultimately, the benefits of transparency might outweigh the risks.
On the one hand, transparency can make the ups and downs less extreme than they otherwise would be because the market kind of knows the way the Fed feels. On the other hand, it can make it worse. The market is going to think about how the Fed is reacting to a piece of data, whether they speak or not. And I think the market is ultimately better off hearing what the Fed has to say or Fed officials have to say about a given piece of data rather than guessing.
CNBC reached out to the central bank for comment and didn't hear back by the time this video went online.